An order executes on a server in New Jersey. 300 shares of a popular technology index fund are purchased. The buyer is an ordinary retail investor sitting in a quiet suburban living room. The prevailing belief driving this transaction is one of participation in a generational technological leap, a transition in human productivity driven by artificial intelligence. The financial media, corporate earnings calls, and global technology conglomerates have spent the preceding 3 years cementing a powerful narrative. AI is an engine of future wealth, and the companies building its infrastructure possess an unassailable position in the economy of tomorrow. But a forensic examination of the macroeconomic data, private credit markets, and supply chain logistics in the summer of 2026 reveals a much more complicated reality. As the decade progressed, some parts of the public market narrative became increasingly difficult to reconcile with the underlying economics. The digital economy, with all its promise and staggering innovation, remains anchored to the physical world and the strict laws of corporate finance. By June 2026, the underlying architecture of the global AI buildout began to expose structural fault lines underneath the AI investment boom. The public equity markets, characterized by historic levels of return dispersion, started to reflect a growing realization that the capital deployed into AI infrastructure faced a profound challenge in matching end-user economic reality. While retail investors poured capital into the public equities of semiconductor manufacturers and software developers, a massive portion of the AI ecosystem's foundation had been quietly constructed on a labyrinth of private credit, specialized debt vehicles, and off-balance sheet commitments.
This divide highlights a critical distinction in the modern financial system. It is a story about who possesses capital and who possesses access to the specific mechanisms of wealth generation. In one arena, millions of people deployed their savings into a system through public equities. In the other, institutional capital quietly financed the physical infrastructure of tomorrow using highly protected, senior-secured, asset-backed debt. This is an examination of the exact financial mechanisms that led to the June 2026 inflection point. It is a look into the financial models of the AI capital expenditure cycle, the private credit networks that finance the hardware, the macroeconomic debates surrounding AI productivity, and the physical bottlenecks that force the market to confront its own velocity. To understand the scale of the financial tension, we must audit the arithmetic of the infrastructure build-out. In 2023, venture capital analysts began to note a discrepancy between the cost of building AI data centers and the revenue generated by the software utilizing them. Initially framed by Sequoia Capital's David Kahn as a $200 billion question, the acceleration of capital expenditure by major hyperscalers, such as Google, Microsoft, Amazon, Meta, and Oracle, expanded this gap as 2024 and 2025 progressed. By mid-2026, the hyperscalers were on a trajectory to spend over $400 billion on AI infrastructure within a single calendar year. The economics governing this expenditure are a subject of intense debate. A widely discussed model-based framework attempted to quantify the revenue required to justify this build-out. This framework makes specific assumptions about the supply chain's unit economics. It begins by taking the run rate revenue forecast of the primary semiconductor manufacturer and multiplying it by 2, assuming graphics processing units represent roughly 50% of the total cost of ownership of AI data centers. The remaining 50% comprises physical real estate, specialized cooling systems, backup generators, and energy consumption. The model then multiplies that figure by 2 again, assuming a standard 50% gross margin is required by the cloud providers or startups reselling the compute power to end users.
Under this framework, roughly $600 billion in annual end-user revenue would be required to support the implied economics of that level of infrastructure spending. However, the actual estimated revenue generated by the AI software ecosystem in 2026 stood closer to $100 billion. Now, it is crucial to understand that capital expenditure generates revenue over multiple years. It is not an expense that must be fully recovered in a single calendar year. Yet the sheer scale of the mismatch raised profound questions about the structural tension between capital investment and realized commercial returns. While frontier model developers saw run rate revenues increase into the tens of billions, operating losses remained substantial, with some external analysts projecting cumulative industry losses to stretch deep into the billions over the coming years. The historical defense for this level of capital expenditure relies on the railroad analogy.
The argument suggests that massive upfront investments in infrastructure lead to long-term economic dominance, much like the laying of transcontinental tracks in the 19th century or the deployment of fiber optic cables during the dot-com boom. The narrative insists that if the infrastructure is built, the use cases will eventually follow. But there is a critical debate about comparing silicon to steel. Physical infrastructure, such as rail or telecommunications fiber, possesses inherent geographical scarcity. If an entity owns the physical tracks between two major cities, it commands a level of pricing authority. GPU computing, conversely, functions more like a rapidly commoditizing asset metered by the hour, with countless new entrants building dedicated AI clouds that continually flood the market with supply.
Furthermore, silicon infrastructure is subject to rapid technological depreciation. As next-generation processors enter the market, previous-generation hardware loses its relative value. The market had to weigh the rate at which next-generation chips would improve against the value retention of older GPUs purchased during the 2023 and 2024 supply panics. Physical railways do not follow Moore's law. A track laid in 1880 did not lose its primary function because a newer track was invented the following year. The AI infrastructure build-out, therefore, represents the mass accumulation of depreciating assets financed by long-term capital, creating a unique economic profile that complicates the historical infrastructure comparison. While public attention remained fixated on the equity valuations of technology companies and the promise of artificial general intelligence, a massive volume of the capital fueling the data center expansion was moving through the channels of private credit. The AI boom accelerated the use of a specialized financial instrument, the GPU collateralized loan. Traditional data center financing often relied on the creditworthiness of the corporate tenant or the value of the underlying real estate. But in the AI era, specialized infrastructure providers required capital at a velocity that traditional equity markets could not easily sustain without significant dilution for founders and early investors. The solution was to use the physical GPUs themselves as collateral for large-scale debt facilities. The most prominent example of this financing model is CoreWeave, an AI hyperscaler that grew into a dominant provider of specialized GPU cloud infrastructure. Between 2023 and 2026, CoreWeave secured a sequence of massive debt facilities, providing a window into how institutional lending adapted to the AI hardware market.
In August 2023, CoreWeave secured a $2.3 billion debt facility led by Magnetar Capital and Blackstone Tactical Opportunities, helping validate the use of silicon as collateral. By May 2024, a $7.5 billion debt facility was secured, anchored again by Blackstone. And in March 2026, CoreWeave closed an $8.5 billion delayed draw term loan facility, achieving an investment-grade rating for a financing secured by high-performance computing infrastructure and associated customer contracts. These deal-specific examples illustrate how infrastructure providers could fund capital-intensive build-outs. Deploying tens of thousands of advanced GPUs requires hundreds of millions in hardware and data center infrastructure. Through GPU-backed debt, companies could fund significant portions of this cost while retaining equity. In CoreWeave's case, facilities included floating-rate tranches and fixed-rate tranches, with maturities stretching out to 2032. To execute these complex debt agreements, lenders required specific structural protections. Capital was often routed through isolated special-purpose vehicles. Deal-specific examples from SEC filings reveal entities established solely to hold the physical GPUs, execute the master leases, and receive the loan disbursements. In these types of deals, lenders might negotiate advance rates of 50 to 70% of the orderly liquidation value of the hardware. They might require monthly borrowing-based certificates detailing GPU inventory, serial numbers, locations, and customer rental contracts. They might impose hardware concentration limits, requiring a high percentage of current-generation hardware in the collateral base to ensure value retention. Covenants might require sweeping cash flows directly to lenders if specific debt service coverage ratios were breached, trapping the cash within the vehicle to protect the creditors. These structures transferred a significant portion of the risk to the private credit markets and institutional asset managers, creating a highly sophisticated web of institutional debt.
As debt accumulated within these structures, observers noted a macroeconomic pattern complicating the picture, the circular financing loop. This dynamic can make it harder to distinguish external end-user demand from demand generated within the investment ecosystem itself.
The pattern often involves three phases. In the investment phase, semiconductor manufacturers or large technology firms invest billions into AI foundation model startups and cloud infrastructure providers. In the procurement phase, those infrastructure providers utilize the invested capital, sometimes combined with GPU-backed debt, to purchase hardware directly back from the same semiconductor manufacturers. In the consumption phase, software startups, heavily funded by the exact same ecosystem of venture capitalists and hyperscalers, use their venture capital to purchase computing time from the infrastructure providers. By early 2026, this tangled web of equity stakes, off-balance sheet commitments, and vendor financing made it increasingly complex to assess the true scale of real external enterprise demand for AI services. When a major semiconductor manufacturer invests in a foundation model developer, which subsequently utilizes those funds to purchase chips from the manufacturer, it boosts top-line revenue. But analysts questioned how much of this represented net new capital entering the macroeconomic system versus capital circulating within the ecosystem. The financial architecture was projecting massive demand, but the boundary between internal ecosystem spending and external economic value creation remained blurred.
The financial architecture rested heavily on the assumption of sweeping macroeconomic growth, driven by the premise that AI would alter global labor productivity. Prominent forecasters predicted massive increases in global GDP, suggesting generative AI could offer a boost in the tens of trillions of dollars. But the academic consensus was far from uniform. In May 2024, Daron Acemoglu, an eminent economist at the National Bureau of Economic Research, published a working paper titled The Simple Macroeconomics of AI. His model produced a substantially more modest estimate than some of the largest AI productivity forecasts. Using a task-based model of automation, Acemoglu applied a version of Holton's theorem, which dictates that GDP and aggregate productivity gains are a function of the fraction of tasks impacted, multiplied by the average cost savings at the task level. Acemoglu's model-based estimate suggested a maximum increase in total factor productivity of less than 1% over a 10-year period. The disparity between the public narrative of a multi-trillion-dollar boost and Acemoglu's model stems from an analysis of how human labor operates. The early successes of generative AI were concentrated in easy-to-learn tasks, writing basic code, summarizing text, or generating images. However, a vast portion of human economic output relies on hard-to-learn tasks that involve complex, context-dependent physical and environmental factors, where objective outcome measures are difficult for a statistical model to parse. When incorporating these hard-to-learn tasks into the model, the predicted productivity gains over the next decade became even more measured. Furthermore, Acemoglu's research found no evidence that AI would automatically reduce labor income inequality, suggesting it could instead widen the gap between capital and labor income.
As the industry sought to push past these limitations, it pivoted toward agentic systems, AI that operates autonomously to execute multi-step workflows. Observers assumed that the rapid decline in compute costs would make autonomous AI cheaper than human labor across the board. But the economics of automation proved to be complex. Because agentic systems operate through extensive internal reasoning, trial and error, self-correction, and multiple verification loops, they can consume vastly more computational tokens per task than earlier models. Consequently, for some complex workflows, inference and verification costs can erode or eliminate the expected savings over human labor. Deploying an autonomous AI agent for complex enterprise tasks sometimes demanded more in raw computational power and API calls than the equivalent cost of a human employee. The realization that widespread AI deployment did not automatically guarantee immediate margin expansion added another layer of strain to the infrastructure boom. Meanwhile, the financial engineering sustaining the expansion was colliding with physical reality. The digital economy cannot expand without a physical ecosystem to support it. The sheer scale of AI data centers triggered a profound demand shock on the global energy grid and physical supply chains. The primary bottlenecks shifted from the availability of silicon chips to the availability of electricity, land, and cooling infrastructure. By 2026, grid interconnection queues in major markets extended for years, with power utilities struggling to handle the gigawatt-scale demands of concentrated AI campuses. The modernization of the power grid required immense quantities of raw materials, such as copper.
Opening new copper mines requires years of geological surveying, permitting, and massive capital expenditure, leading to supply constraints exactly when the digital economy demanded exponentially more physical material.
Hyper-specific supply chain constraints also emerged. For example, the United States relies heavily on limited domestic production of grain-oriented electrical steel, the core raw material required for manufacturing electrical transformers. A data center cannot operate without transformers, and transformers cannot be built without this specialized steel. The physical supply chain operates on a timeline that often clashes with the demands of venture capital and public equity markets. Delays in capacity delivery forced some infrastructure companies to defer projected revenues, testing the debt service coverage ratios built into their private credit facilities and increasing overall execution risk. As these microeconomic and physical realities set in, the macroeconomic risks drew the attention of the highest levels of global finance. The Bank for International Settlements, the central institution coordinating global central banks, provided some of the strongest independent evidence of the mounting pressure. In their 2026 annual economic report, the BIS warned of vulnerabilities arising from the intersection of record-high public debt, financial fragility, and the sheer velocity of the AI investment boom. In a working paper analyzing the AI investment race, the BIS modeled the boom through the lens of contest theory. In a winner-take-most technological environment, firms are incentivized by contest externalities to commit massive amounts of capital to secure a dominant market position. Terrified of being left behind in the foundational model race, competitors push investment to the absolute limit. Calibrating their baseline model to actual balance sheet and deal data, the BIS researchers estimated that the AI sector was generating overinvestment at around 1.5 times the socially efficient level, and discussed how this could rise even higher in areas where demand was less elastic. The BIS noted that this dynamic, funded heavily by leveraged private credit structures and circular equity ties, introduced significant financial fragility. Because AI hardware is highly specialized, the safety net of liquidation recovery could be compromised in a downturn. In a high-stress scenario, fire-sale dynamics of specialized assets could induce losses that scale with the amount of debt in the system, potentially cascading through the concentrated network of creditors and hyperscalers.
Furthermore, the BIS highlighted a growing sovereign financial stability nexus. With global public debt at historic highs and financial markets increasingly influenced by non-bank financial intermediaries financing the tech boom, the interconnectedness of AI private credit facilities, hyperscaler balance sheets, and sovereign bond markets created a delicate balancing act. Shifts in technology valuations carried the potential to tighten global financial conditions rapidly. The accumulation of these structural stresses, the massive revenue requirements implied by the infrastructure models, the complexities of SPV debt structures, the rigorous academic debates over productivity, the BIS estimates of overinvestment, and the physical constraints of the power grid reached a critical threshold in the summer of 2026. June 2026 exposed the fault lines in the AI investment boom. The global stock market experienced intense dispersion and volatility. The CBOE S&P 500 dispersion index spiked, indicating that the underlying fabric of the market was undergoing severe stress. Return dispersion amplified across asset managers as capital began to forcefully reassess the AI narrative. These market movements were evidence of strain, not proof of a completed systemic collapse. Valuations were pressured. In a single trading session in July, major semiconductor firms saw hundreds of billions in market capitalization fluctuate amid escalating fears regarding the sustainability of demand, regulatory shifts, and trade limitations. Active managers, caught in a squeeze-like dynamic, were forced to navigate extreme volatility, where a handful of stocks drove the vast majority of index returns. Enterprise software buyers began demanding verifiable return on investment, leading to a wave of distressed mergers and acquisitions in the application layer, where engineering teams and models were absorbed by incumbents for fractions of their previous venture valuations. But the exposure of these fault lines in June 2026 did not erase the technological leap. History demonstrates that transformative technologies can be entirely genuine, while the financial structures built around them become overstretched. The technology is real, the infrastructure is real, the capital is real. The question is whether the economic returns can catch up with the enormous amount of capital being committed today. The public markets spent 3 years trading on a narrative that sometimes struggled to reconcile with the gritty, physical, and highly leveraged reality of how the infrastructure was actually built.
The true mechanics of the AI era are tethered to the strict covenants of private credit, the availability of electrical transformers, the yield of copper mines, and the cold mathematics of enterprise software margins. The leverage in the system is held by the private credit funds securing physical GPUs, the commodity firms controlling the raw materials, and the utilities managing the constrained power grids.
The opportunity generated by this technological transition did not disappear when the fault lines fractured in June 2026, but the location and the risk changed. AI remains a defining force of the modern era, but the financial architecture built around it may be much more fragile than the world ever realized.